Today, the natural but unnatural acts that will be used to try and save the mortgage system. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news with a distinctively Australian flavour. Well, as I've been saying for quite some time, with interest rates rising and with more households falling into financial pressure, as measured, for example, in our mortgage stress series, or as reported by Roy Morgan in their latest series with more than 1 million in stress on their numbers, clearly banks are getting concerned about how to help households through this period of pain. And so we're already seeing, for example, discussions about 40-year mortgages. We're seeing examples where bankers are now saying to people, well, just go interest only and then pay the capital from your mortgage off with superannuation when you retire. And quite often when people get refinancing, they're pulling cash out if they can and covering off some debts to try and keep the ball in the air for longer. And, of course, we have a number of other initiatives, including more support to try and encourage first-time buyers to go into the market to buy, to support the property sector, and even things like stamp duty changes, as in New South Wales, to try and keep the ball in the air. Plus, of course, migration, and, well, migration might help to support home prices and therefore the mortgage sector. The question is, will it be successful? Well, maybe or maybe not. But maybe we should look to Spain, because there they've gone a step further. Because Spain, according to Bloomberg, announced a series of steps to shield mortgage holders on lower incomes from rising costs, stepping up efforts to cushion the economic blow from high inflation and surging interest rates. Ministers will approve measures helping more than 1 million households on Tuesday, with agreement on final details with banks still pending, according to an Economy Ministry statement. Rising interest rates have put an end to a decade-long boom for the real estate sector across Europe, and concerns are growing that the strain will spill over to the wider economy. In Sweden, authorities have warned that property debt could pose a threat to the country's financial stability, while Poland declared a mortgage moratorium to provide relief to hard-hit home owners. Mortgages are a pressure point for the economy in Spain, where about 70% of loans for home purchases vary in lockstep with changes in interest rates. The main 12-month Euribor reference rate has jumped to more than 2.6% from minus 0.5% a year ago, after the European Central Bank embarked on its drive to tamp down on record high rates of inflation. So here are some of the main points of their proposal. Firstly, lower interest rates during the 5-year grace period for vulnerable families earning less than €25,200, while also allowing them to carry out a second debt restructuring. Second, allow households access to a 2-year grace period with a more favourable rate during that time, and extension of up to 7 years on the loan term. Next, permit middle-class households with an income below €29,400 a year to freeze monthly payments and extend the period of amortisation by up to 7 years. The new package is another example of Prime Minister Pedro Sanchez's willingness to intervene in economic affairs, as surging living costs pile on the financial pain for Spaniards. The socialist left coalition Sanchez leads has been at the forefront of some of the most radical economic policies seen this year in Western Europe, imposing windfall taxes on energy firms and banks, capping the price of gas used for power generation, and limiting rental price increases. Sanchez has said big business should contribute to funding the €35 billion price tag of the economic relief measures, an amount that's equivalent to about 2.5% of the country's economy. The European Central Bank warned earlier this month in a non-binding opinion that the tax on banks could hurt lenders that are not booking higher profits from rising interest rates and distort competition in the industry. So here is an example of, well, I guess you'd call it mortgage keeper. And I just wonder whether that's something that we're going to see here in Australia, because clearly the industry and probably the government behind the scenes and the regulator are trying to work out how to protect people. Protect people from what? from 30 years of bad policy, from 30 years of too loose a lending to the point where people are in hock up to their eyelids. And of course, with interest rates rising, the pressures will continue to build. And as I highlighted in an earlier presentation recently, of course, next year we have the fixed rate reset problem, where about a quarter of all the mortgages in Australia are going to move up to considerably higher rates. It's also worth noting that Phil Lowe, in a speech last night at Cedar, made the point that the economic pain is going to continue for some long time. Inflation will be high for perhaps the next 2 or 3 years. He has suggested that people should not try and grab wage rises because that'll just make inflation worse, but clearly doesn't get what's going on in the living rooms of households across the country. Sure, there are many that are fine, but there are many that are not. So I wouldn't be surprised to see many more initiatives coming out of the woodwork to try and protect households. But of course, what they're really doing is trying to protect the mortgage industry and the banks. Why? Because somewhere between 60 and 70% of all bank assets are actually tied directly or indirectly with property. And if property falls, mortgages fall. If mortgages fall, the banks are likely to get into difficulty too. So there is a rising imperative to bring in Mortgage Keeper. I wonder how long it will take. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.